not too long ago, Matt and Lisa had come in to meet with me, and he was 63, she was 61. Now she had already retired a couple years earlier, and the fact of the matter is that they were in great shape. I mean, they had good savings, they had reasonable expenses, and Matt was also still working. And so when we sat down, one of the first things that they had said to me was that they said that the markets had really been good to us over the last few years, and we're kind of thinking that we're ready, ready to retire. And they both just kind of had that energy, like they've done the work, they've done the hard part, right? They've caught maybe some good timing the last few years, and now they saw that the finish line was finally in sight. And the thing is that I get that feeling. I mean, when you spend decades focusing on saving and investing and accumulating money, I mean, getting to that point feels like like crossing a finish line. But there's something that I've come to believe after working with a lot of people throughout that transition into retirement, and that is that getting to that number is actually the easier part, because now what you actually do with it and how you turn what you build into income and how you manage the taxes and really just how you plan it all out. I mean, that's really where it gets, a lot more nuanced. And that type of planning really needs to start before you retire. And by the way, if we haven't met yet, I'm Ryan Kravitz. I'm a certified financial planner professional, and I help people transition into and through retirement. All right, let's get into it. Let's talk about Matt and Lisa here. So as I mentioned, there's 5 things that just kind of stood out. So let's go ahead and jump into the first one here. So the first one had to do with their asset allocation. And so when we took a look at Matt's 401k, the allocation that he had, he told me he really hadn't touched it in years. And quite frankly, in retrospect, or in hindsight, maybe I should say, they had been invested quite aggressively overall, including his 401k. And, the market's been good. And that's a big part of why they were sitting across from me feeling ready now. But, there's a shift that has to happen at this stage, and arguably even a little bit before this stage. But although it makes sense that they have to now make this shift as they're approaching retirement, have to start needing this money for income, it gets very hard because there's, things have been going well. So for a lot of people, the feeling is that, why make a change? Things are going well. There's no obvious, reason to have to change anything. The issue is that the ball game is all different now. I mean, the focus is no longer about accumulating more. I mean, really, the main focus is now on how to turn this money into a reliable income stream. And when things are going really well, and again, there's no obvious reason then to make that change, it can turn into a big problem. I mean, we've seen this story before. I mean, people that retired right before the tech crash of 2000, or right before, October of 2007, and they were heavily invested in stocks, and everything had been going up to that point. So again, no obvious reason to change. And, and of course, yes, the markets eventually did come back, but if you're pulling money out while it's going down, while your, investments are going down, well, then you're selling at the worst possible time. And that sequence of returns risk. And it's the most dangerous right at around the time that you make that transition into retirement. At the same time, Matt was 63 and Lisa was 61. So they could easily live for 30 or more years in retirement. And in fact, the chances of at least one of them living for 30 or more years is quite high. So you can't just move everything over to conservative investments and say, hey, I'm retired now, I'm just going to go super conservative, and call it a day, right? I mean, that's going to be an issue as well, because over the course of time, inflation is going to quietly erode everything. So you still have to have a meaningful amount that's in equities. So what we looked at for them was just making sure that the money that they needed in the near term in those first few years or so, that wasn't going to be subject to market swings, or at least not big market swings, while also making sure to keep the longer term money still working hard for the future. And, I also use a guardrails framework to manage spending over time, which will factor in how allocation is set up. But the starting point is just making sure that the structure matches how they're actually going to use the money, year by year. once we had that foundation in place, it opened up something that I don't think Matt and Lisa were expecting. And that is a real opportunity for them on the tax side. Let's get into that. So the tax planning part of this is really the second thing. So, his idea was just to go ahead and live off the savings that they had for the first few years, because they had built up a good amount of savings. But what I showed him was that if he did that they wouldn't be fully utilizing their deductions, even just a standard deduction. And so I said, we at least want to utilize the deduction. So we have opportunities here to, harvest capital gains, or more specifically here, to draw down from this 401k a little bit and start getting some money out, while either potentially paying no tax or, paying tax at a low tax rate. And so we want to take advantage of that. Also, if he just lives off the savings and then they have that 401k continuing to grow, well, that can, continue to grow into potentially a larger amount, and then they'll have less flexibility on where they can withdraw money, and it might turn into larger RMDs than they would have wanted to have later on in their 70s. And their reaction was pretty much, okay, wait, so by not touching the 401k, you're saying we're actually going to make things harder for ourselves down the road. And in their situation, that was exactly right. I mean, they weren't using the standard deduction. They'd have less flexibility on accounts later on and things like that. The window that they had right now, Matt retiring early in the year, that would then open up, opportunities from a tax planning standpoint, even in that first year of retirement. It would be one of the better opportunities that they'd have then to then start moving money out of the 401k at lower rates. I mean, we're talking, 10 or 12% in their situation on, in doing strategic Roth conversions as well. I mean, for Matt and Lisa, the RMDs for them won't kick in until 75. I mean, that's the age for anyone that's born in 1960 or later. So they had a bit more runway than most people have. Like if you retire late, he's going to have 10 years before RMDs even kick in. And she'll have, 12. She had a smaller 401k. And then there's something that I want Matt and Lisa and really anybody watching this to really think about. And it's called the widow's tax trap. If one of them passes, the survivor goes from married filing jointly to now single. So the tax brackets compress, the standard deduction drops, and now those RMDs at 75 are hitting one person at higher rates than they would have hit two if you're married filing jointly. And so possibly doing the conversions now while they're both here and managing how much they're withdrawing, managing their tax picture over the course of their retirement and taking advantage of that window of time before RMDs begin. That could potentially, especially while they're both here, while they're both alive, that could potentially put that surviving spouse in a much better situation there in the future. How and when Matt and Lisa claimed Social Security was going to directly affect how much of that window that they could actually use. So that was the next thing that we had talked about. And Matt had just kind of assumed that he claimed Social Security when he stopped working, and Lisa just figured that she'd take hers at 62 because she's already retired, but that's as soon as she can. Now, neither of them had really questioned it. They just kind of figured that, hey, once the paycheck stops, once we're both done working, might as well go ahead and turn on Social Security. But in their case, when we actually sat down and looked at both of their benefits together, I think they found that there was a lot more to think about than either of them had actually expected. I mean, for Matt and Lisa, they were both born in 1960 or later, so their full retirement age is 67. But here's something that I think is worth saying, because just because they call it full retirement age, that doesn't mean that's when you should claim, right? It's the full retirement age. No. I mean, yes, for some people, yeah, age 67, that might be the perfect time for you. Don't get me wrong, but what I am saying is here is that really the way that it works is that when you turn 62, you could take it then, and then each month that you delay up until the age of 70, your benefit is going to go up by a little bit. And so you could take it anytime between 62 and 70. And so just because the name is they call it full retirement age, it's just a name. I mean, it does come into play, certainly around spousal benefits, survivor benefits, things like that. But we're talking just their own retirement benefit here. I mean, the right time to claim has to just come down to the actual plan. And one thing that kind of changed what we were thinking about is that, she has the smaller benefit and he has the larger one. And, whichever of them passes first, well, the survivor is going to keep the higher benefit. So there's real logic here to wanting to protect his, by thinking about delaying it for as long as might make sense. And so we started thinking through, a possible split approach where we would delay his benefit potentially even up until the age of 70. Maybe not, we'll see. And then also have Lisa take hers earlier since hers is the smaller of the two. Again, nothing locked in here, just working through the trade-offs. But one nuance that did come up for Lisa is that since she's already retired and she doesn't have any earned income, she could actually file for her benefit in the same calendar year that Matt's still working. So even if Matt's income is over the earnings limit, it won't affect her benefit at all. The earnings test only looks at your earned income, not your spouse's. So if you're not familiar with the earnings test, I'm referring to if you were to apply for Social Security for your own retirement benefit before your full retirement age. Now for Matt, if he retires early in the year, and if he does want to file, now he probably won't. We're talking that split strategy. He'll probably delay a bit, but if he were, there is a monthly earnings test, and this is important to know about, that can apply in that first year of claiming. So even if his total annual income was over the annual earnings limit, well, once he stops working, his monthly earnings would then drop to zero. So he can still receive benefits for those remaining months, but you have to reach out to Social Security and let them know. And here's what I could see happening as we were going through all this. Matt and Lisa, I think we're really starting to realize that none of these decisions were really separate. I mean, the more we talked, the more it became clear that, what they did was Social Security, how they filed, when they filed, all that was going to affect the tax window. That was going to affect, the ACA subsidies potentially and such, which all loop back to the conversions, the Roth conversions. It's all one big picture. And really, that's exactly why you have to look at all these things together. With the income and the tax and Social Security pictures starting now to come together, the next thing that we had to work through was the one that a lot of people don't fully think through, and that's healthcare. And that was certainly the case for these folks. So when we got to healthcare, neither of them had really mapped it out. I mean, they knew they needed to figure out something before Medicare. They needed to get insurance, but they heard also that it was going to be expensive. But their feeling was, hey, it's only a few years away, and it's. Yeah, the premium's probably going to be high, but it's probably doable. So it is what it is. And here's where it got interesting. I mean, Matt was 63 and a half about, and that meant by the time that he actually retired, he'd be right around 65. He might actually decide to retire right at 65, as it turns out, and heading straight, into Medicare, at 65. But, for him, as a result, if he does that, I mean, it's going to be pretty much a non-issue. And for him, I could see that he was kind of like, okay, I guess I'm all right. But then, what about for Lisa? So for Lisa, well, she's 61 right now, and she's been on Matt's plan, through his employer. And so when he retires, that coverage is going to go away. And so okay, so what does she do? Well, she's still got a few years here until Medicare, and suddenly, this isn't just the minor detail. We've got to, think through, what are we actually going to do? She could stay on COBRA. I mean, as a spouse, she's actually eligible for up to 18 months of continuation coverage. But when we really talk through what the actual cost could look like, I mean, that's when the sticker shock starts to hit, because I think this happens for a lot of people. I think a lot of people know the employer's, contributing a good amount to the health insurance, but may not fully realize just how much. And so, that's when that sticker shock could sometimes happen. And so, the coverage for someone Lisa's age, that could easily run thousands of dollars per month. I mean, it all depends, of course, on the type of plan. The range can be big, HMO, PPO, the deductibles, all those things. Now, because Matt was thinking to retire early in the year, well, their income was going to be meaningfully lower. And so this was then going to open up the possibility of those ACA marketplace subsidies then for Lisa. And depending on where their income landed exactly, those subsidies could cut that monthly cost by quite a bit. Now, here's a nuance though that that came up that makes this a little bit different. So, yeah, remember, for him, he's going to be on Medicare by the time that she would go on an ACA plan if she does. And so when we looked at the pricing for this, if they were both going to be on an ACA plan, those subsidies would really be meaningful. They would be quite high. But if it's only her on the ACA plan, yes, there would still be nice subsidies, but they aren't nearly as high as they would get if they were both on a plan. And so we had also been talking about the Roth conversion conversation and, whether to do that or whether not. And so, by him, maybe not retiring until 65 and then going right on Medicare, now if they were to do conversions, maybe at that stage or thereabouts, now if they were going to do a large conversion where they would then lose out on the subsidies, well, now if it's only her on the ACA plan, the subsidies that they would be giving up would be significantly less. So that definitely factored into the conversation when we were thinking through those things. Now, another thing to factor in that we need to consider is also IRMA, because if those IRMAs or if those conversions push income high enough down the road, then your Medicare premiums are going to go up. So, I mean, none of this is a reason to avoid conversions necessarily, but you just need to know how these things work to make sure that you're going in with eyes wide open and that okay, if I do this, then that's what, this is what happens. All right, let's get into the last category here, which is Matt had a pension. Not a big pension. It was just a smaller pension that Matt had gotten from earlier in his career. And he was going to have to make an election on that, which option, to receive, the life only, joint and survivor, those things. And he mentioned he was just kind of thinking he would take the joint and survivor option because if he passed, that, at least the benefit would then continue on, to Lisa. And, as I mentioned to him, that could certainly make sense. But what we want to take a look at is, those actual numbers that you get, because sometimes taking the higher, the life only payout and then using some of that extra money to then fund a life insurance policy, well, that can make sense. I mean, again, it comes down to the specific numbers, but it could potentially make sense for him because let's say that he does that and then she passes away, before he does. Well, then he could just drop the policy and then he'll end up having that higher pension amount. On the other side, if he passes away early, well, then it's not like she's all lost. She'll get the life insurance policy. And so when you run the numbers, sometimes that can make more sense. So that was really the last thing that we had taken a look at there together. When Matt and Lisa walked out of that first meeting, I really don't think that either of them expected it to go the way that it did. I mean, they came in, like I said, that they feeling like they had hit that finish line, that or at least that it was the finish line was coming. I mean, what they left with though was now a clear picture of just how much was on the table, of what decisions they needed to be made, and what they needed to be now thinking about going forward. If you want help thinking through these different things and helping plan out your retirement and your financial picture, there's a link in the description there to learn more about how I work with people. And also there's a place there where you can schedule a call. I want to thank you for watching, and I'll see you in the next video.